Hello everyone, it's Nick Harrington here. Today in this video, I want to walk you through how I analyze my deals for my rental properties. If you're watching this video, it's either because you're working with me as a client and I am your real estate agent here in Milwaukee. Maybe you stumbled upon this because you're just a new investor looking to learn about how to start analyzing deals, or maybe you're a seasoned investor as well. But in this video, what I want to walk you through is how I analyze deals. We're going to look at a listing. We're going to then look at a tool I use called Rentometer that shows what market rents are for an area and an address. Then we're going to use a spreadsheet that I've created. That's really my bread and butter to determine cash flow. And then we're going to couple this with a Bigger Pockets calculator. If you don't know Bigger Pockets, it's a forum, a group, investor like-minded network. And I think this is really the perfect starting ground for anyone that's looking to start analyzing deals. And it really is a great way for you to couple with the calculator that I've created, just the short-term cash flow with the Bigger Pockets calculator, which is going to be that long-term return that you're getting in an investment. Because something that's always very important to remember in real estate investing is it's never a get-rich-quick game. It's not buy one property and retire. It's going to be the long-term appreciation and wealth generation that you get, because the benefits of real estate investing is if it's cash flowing, you have some money that's coming in. But over time, you now have an asset that someone else is paying for you, where 10, 15 years down the road, you all of a sudden have an asset that's appreciated in value. You have some money coming in, but someone has essentially paid this asset for you on your behalf. So that's a quick high level, but let's dive into one deal here, and let's just get started. So probably where you're going to start with your search is you're going to have a listing. This might be a listing that you're seeing on Zillow, Redfin, Realtor.com. If you are using Zillow, Realtor, Redfin.com, I'd recommend you to find a local agent that can get you hooked up on a more updated and current search, just because sometimes the status isn't always updated on those websites. So we've got a search here. This is a duplex here in Milwaukee, 2801 North Palmer. The big things that I always like to look at when I'm looking at a listing: the purchase price, the neighborhood, and then the taxes. Sometimes you're going to see here what the rents are for the duplex, sometimes not. If not, it's okay. You can still analyze this deal. But I always just like to get an overall sense of the property's condition by looking at the photos. Something like this, I'm seeing there's not a lot of photos, which tells me it's probably not in the best condition. You can kind of tell here by the walls that it's got some work to do. It's got some new flooring, but older appliances. So this might not be pulling in the highest amount of rents it could, but it's got some work to do to it. And then if we look at the area here, that's really just going to depend on your own market knowledge of if this is an area you want to invest in or not. If you're not familiar with Milwaukee, I'm happy to share my 2 cents on areas that I see a lot of investors succeed in. But that's going to come with a lot of just market knowledge of what it is in an area that you want or not. So I typically then go from here. I myself as an agent have access to the MLS, which within here, I'm able to see sometimes they put rents in here, sometimes they don't. This one is not in here, but if I look in this document section, they put the rent rolls in there where it says that one unit is vacant, one unit is paying $850 a month. And then let's hop over here to Rentometer. So we are here on Rentometer, and if you're unfamiliar with Rentometer, it's basically a website that is used to calculate what market rents are for an area. There's a free version, which allows you, I believe it's like 10 reports, or a pro version. It's very affordable. If you're thinking about getting into investing, I highly recommend investing into Rentometer because it's a tool that is very easy to use. It's cheap, and it gives you really good information that you need to succeed in investing. So let's type in the address here. This is going to be a 3-bedroom. It's a duplex, and we're going to do a half-mile radius. And let's just hit analyze and see what this pulls in here. So this is going to give us a snapshot of what rents have pulled in for the last 12 months in the area. I always like to make sure this radius is wide enough where it's capturing enough rental properties, but it's not too narrow where it's not pulling in enough, but it's not too wide where you're starting to get rental properties that might not fit exactly what this block or this exact neighborhood pulls in for rents. So here we can see the average and the median rents for this area, the 25th percentile of rents and the 75th percentile of rents. A general rule of thumb, I always want to find something that's pulling in right below the average or the 25th or around the 25th percentile of rents. Reason being, for me, it's a better investment if I'm able to do some light cosmetic work to increase rents to get them closer to that 75th percentile, because right there I'm now cash flowing higher than I was before. But I purchased a property at a price that was more reflective of a 25th percentile or an average rent amount. Granted, I want to make sure that the property is in good condition, mostly just cosmetic, but that's just something to think about. That just because it's something's pulling in the highest amount of rents possible doesn't necessarily make or break that as a good deal or not, and vice versa if it's pulling in the 25th percentile of rents. So here we can just kind of get a gauge of where the rents are for this area. And so from Rentometer, then I hop over to my spreadsheet with this information. And so here is a spreadsheet that I use, and I think about this spreadsheet as a cash flow snapshot of what the property is pulling in right now on the left side, which is what we see as the current state. And then this stabilized state is what I think the future potential of the property can be. And again, this is more just a cash flow calculator. So if you don't have access to this spreadsheet, let me know, send me a message, and I can make sure you have a link to it. The whole design behind the spreadsheet is you just need to input the blue pieces here, and everything is going to autofill in for you from the blue pieces. So let's just start with what each of these sections are. And then I'll go into what each of the different lines mean. And then we'll talk about how I would analyze this deal. So the details, this is going to be just your list price, your offer price, and your number of units. Revenue is going to be how much rent this is pulling in, or maybe if there's coin laundry, how much that is pulling in. Your expenses are going to be expenses that you have on the property. This is going to be your loan structure. So how much percent down you're paying, what your interest rate is. Your metrics, this is really going to be the output. This is going to show you all the fun things like your cash flow, your cap rates, your cash on cash. And then here's where you're going to want to put in any additional improvement costs that you think are necessary for this property. So if we break this down a bit more, right now for this unit, this property, one unit's pulling in $850 a month, one is pulling in $0, which is why I have these numbers here right now. If we look at the expenses section, I put my taxes in here, which you could pull from the listing. You then are going to have different expense buckets in here. And so a lot of these buckets, I calculate my expenses in terms of percentages. So if you see a 10%, 8%, that is reflective of a percentage of the monthly rent. One more thing too, in here, all this information pulls from your offer price. So that way, if you want to manipulate what you want to offer to see if it's going to hit the numbers you want it to hit, you just have to change this offer price right here. So I always bake in a management expense about 10%. Here in Milwaukee, you're going to see anywhere from 8% to 12%. Then we have maintenance, capital expenditures, and vacancy. Now, these three expenses aren't expenses that you're paying out of pocket every month. They're just budgeted expenses. So you now have $68 a month going towards maintenance items, which are going to be like your day-to-day. I need a new light bulb. I need to change this small thing. We have a drywall problem that we need to repair. Your capital expenditures are going to be your long-term big ticket items. Think roof, think furnace, think siding. And then vacancy is going to be during turnovers of tenants, where you might have a couple days or weeks of downtime and you want to budget for that accordingly as well. And then we have insurance. For a duplex here in Milwaukee, insurance each month is typically going to be about $110. I think that's on the higher side, but it's a fair number to use. And then utilities. This is any utilities you're going to pay as the owner. If I go back here to the MLS listing, typically it's going to say what the owner pays, water and sewer. Sometimes it says none. Sometimes it says all utilities. So that number is going to change each month based off of what you as the owner pay. So we talked through everything here on the left side. Now let's go into the loan structure. Your interest rate, here you're going to type in your interest rate, your amortization period. So we're just looking at a standard 30-year mortgage for this. And then here we have some different options for what our down payment percentage is going to be. And again, you could edit all of these if you want to compare a 15% to a 25%, so on and so forth, different loan. And you can see exactly how much you need down, what your loan amount is, what that monthly payment is, and what that annual payment is. And so I like this because you can compare and contrast the difference between maybe doing 15 to 25% down and what this outputs for your metrics here. So let's then look at the metrics section. And I want to break down what these different pieces are, because this is really, when I think about cash flow, this is the section that I'm focusing on. So monthly cash flow, that is basically how much money you have in your pocket at the end of every month. And for the sake of this, let's just pretend that this other unit is rented also at $850, because then we actually have some more realistic numbers to work with. So monthly cash flow, that's after you receive your rent, you pay your expenses, and you pay your mortgage, how much money you have left over. Annual cash flow is going to be your monthly cash flow times 12. Cash flow per door is going to be your monthly cash flow divided by how many units you have. Cash on cash return, this is going to be the most equivalent to if you were to take, in this case, you're doing about $25,000 down and $2,500 worth of closing costs. So you're looking at, if we did 25% down, you're spending about $27,500 all in on this investment as it sits right now. This cash on cash return number is saying if we put that $27,000 into the stock market and we get a 24.11% return, or we can invest this in real estate at a 25% down to receive the same 24.11% return. To me, it's the most apples to apples comparison to how we think about like a stock price return, a stock market return. It's the return on the money you're putting in. Return on investment is going to be the exact same thing. It's the return on the money that you're putting in, but it includes taxes that you're paying. So that's why you're going to see a lower ROI compared to cash on cash, because it includes your taxes. ROI is going to be at ROI at what year, means at what year are we going to see the money that we've put into it? Are we going to see a break even in that? For instance, if we do 25% down, we're going to see at year 6.7, we're going to get that money back in terms of monthly cash flow. Rent percentage of sale. This is just a number that I like to use so I can quickly at a high level determine what this is it's taking a look at the monthly rent and dividing it by your offer price. And so I know that if this number is around 1%, so if my monthly rents are going to be 1% of the offer, in this case, it's an offer of 100K. If I'm pulling in rents of about $1,000 a month, typically that's going to be cash flowing in a way that I know. And it's a way that I can just quickly look at a deal, the purchase price, the rents, and know, is it around that 1% mark? It is. This is probably worth investigating. It's not even close. It's probably not going to cash flow the way that I want it to. Capitalization rate is in looking at your purchase price divided by your net income to determine, net income divided by your purchase price to determine what your capitalization rate return is on this property. So this is really the current state of this property. It'd actually be this right here. Okay, so now that we talked through this current state here, what all these different buckets are, the last one I want to talk about is closing costs and property improvement costs. So you're going to put your estimated closing costs in here. And then also if there's any immediate repairs that you think you're going to need in this, let's just say we know it needs about $4,000 worth of gutter and siding repair. The numbers up here are going to change as well too. Let's just, again, say we had $850 pulling in on the second unit. This is going to change what your cash on cash and your ROI return is, because this is additional cash that you'll be spending out. It does not affect your monthly cash flow, but it's something also that you want to consider too, that what are my all-in costs on this property and how's that going to change what I need from a cash on cash return for my numbers. So this current state on the left, this is where I always start, but then I always want to think about what's the potential of this property. Where can this property go? And that's then if we move over here to this stabilized state, that's how I determine what is the future of this property? What's the potential? If this is stabilized, if it's updated on the inside and I'm getting market rents or better, what does this look like? So again, I always like to hop back over here on Rentometer to see what is a reasonable rent that I can get that's at that median price. So it looks like $1,250 here. I probably do some more due diligence than just trusting this median number, but for the sake of this example, let's move forward with this. So I can go ahead and put $1,250 per door in here. It's going to update what our metrics are. And we can see that, I mean, this thing is, the cash flow has gone up significantly. Our cash on cash return has gone up significantly as well. We're going to want to pull in over here our gutter and siding repair, but more than likely, in order to go from where we are at the current state on the left, pulling in about $850 per unit, I'd say, as is, to getting closer to this $1,250 mark, this median rents, we're going to have to put some cosmetic upgrades into this. And so let's just say you walk through the property, or you have an agent walk through the property on your behalf, and it comes out to be that there's about a $35,000 rehab for cosmetics. And then you can start to see, okay, if I even get these increased rents, do all this additional work to the property, how's that affecting my cash flow, which has gone up significantly? But more importantly, how's that affect my cash on cash return for this? And is it worth me putting these additional investments into the property to see this additional rent compared to just keeping it as is? So all things just to consider and think through. But this is really, again, the left side is the current state. The right side is this future state of where you think it can be. So then where I like to go from here, once I have updated this current state, this stabilized state, I'm talking through this really slowly. Once you start doing 1, 2, 3 of these, this is going to be like second nature for you. These numbers are going to be filled in a lot quicker for you once you just get the hang of how this works and what you're looking for. At this point, though, I always like to pause and see, just from a cash flow perspective, does this hit the goals that I'm looking for as an investor? For me, I've got specific goals of what I'm looking for from a cash flow perspective and a cash flow per door perspective. And so that's really up to you first off to determine, does this hit your, I would call them more of the short-term goals. Cash flow is very much a short-term goal, but again, you're never going to get rich off of cash flow. It's more of, is this enough to pay the mortgage, pay your expenses, and then maybe have some money on the side that's coming in too. So let's say that this does, and I can tell you that just looking at this is a deal that from a cash flow perspective is one that I'm interested in. My specific parameters is I like to see at least 250 cash flow per door. This one is absolutely crushing it. I think we are being a little bit generous on the numbers here as well. But so then where I like to go from here is to a bigger pockets calculator, because this spreadsheet does a great job of just the short today snapshot, potential future snapshot from a cash flow perspective, but it loses emphasis on the long-term play of why I invest in the first place, which is to generate and create long-term wealth. So if we move over to this bigger pockets calculator, essentially you get, this is on biggerpockets.com. If you just look up their calculators, I input the numbers here. And it's going to be a lot prettier of a report than the spreadsheet I have created for an outcome. But where I just want to focus on is this long-term return here, where this is basically going to show you your profit if you sold the property at year 1, 2, 3, so on and so forth, because this is why I invest in the first place. It's this year 5, year 10, year 15, year 20 mark, year 30 mark. You're seeing some exponential returns in profit. And this profit is looking at your cash flow each month over time. But it's also just looking at, if you sold the property, how much are you up in this deal from an equity perspective, also accounting for market appreciation over time. And so let's say you bought this property, you held it for 15 years. The real power to real estate investing is that by you making this initial investment, in this case of, let's say you did 25% down, 25K plus $66,000 here. Your now profit from 66K is looking at $211,000 because you had someone else that's paying your mortgage every month. You're taking home some money as well in cash flow. And then at this point, you have the option to sell it and just cash out and take the money. There's also some different loan options that you could do as well, looking at a refinance and a cash out refi to pull out some of this equity in the property. So I think it's good to couple up these two together, because this is really the whole idea behind investing. It's got to make sense from a cash flow perspective. It's got to make sense from an appreciation perspective. And if it hits those short-term goals, the long-term appreciation, it's probably a deal that's worth investigating further. And so then there's one more section on the calculator I want to talk about as well. And this is going to be, if we look at this refinance and hold analysis. And so the whole idea behind this is you purchase a property, you rehab it, and now because you've rehabbed that property, the property is now worth more than what you bought it for. So I want to walk through how you can do some calculations with this refi and hold analysis and what this all means. And I'm just going to start plugging into it, and I'll explain it as I go. So let's say that we bought this deal. We did the rehab, which we estimated here at 41.5, and we did a 25% down mortgage when we first bought this property. So our down payment, we bought it was 25%. We could see what our total investment all in on this is $66,000. That's going to be the 41.5 of our repair and closing costs, but then also the down payment. So all in, we're at 66.5. Now let's say that because we've done about $41,000 worth of rehab work, that we can now go and sell this home on the market for $200,000. And let's just say that just kind of making up numbers here, so don't hold me to this. But let's say we could now sell this for 200,000. That's our ARV, our after repair value. What we can then do is go to the bank and request an LTV, a cash out refinance, which basically we can go to the bank and say, hey, I now have this asset. It's worth $200,000. I want to take out a mortgage on this new value of the home. The bank will then give you a 75% loan to value ratio. So they'll give you 75% of your home's worth in cash. And then you now have a new mortgage. You basically just refinance at the new price. So you then would have a new loan. In this case, if your ARV was 200K, went to the bank and took a 75% cash out refinance, you now have a new loan on the property of $150,000. You would pay back the original loan once you refinance, which was 75K, because we put 25% down. You'd probably have some closing costs on this deal, on the refinance, about $4,000. So when we do this, we would actually recover about $71,000 of capital that we're left with once we pay back the original loan. And in this case, actually, we've pulled out enough to offset our total initial investment. Since we recovered about, we in this case would recover $4,500 more than what we actually put into this. So in this case, we'd actually have a property that we essentially got at no cost when it's all said and done, because the refinance amount that we pulled out offset our down payment and our rehab costs. We now would have a new interest rate for this property. Our new mortgage payment would be about $973. Our new cash flow is about $402. And we can see we actually have a negative cash on cash and a negative ROI, because in this case, we are playing with house money. I think what's more realistic is if we put an after repair value of about $150,000 here, this is going to be more typical, where once we get this new loan amount of 112, pay back the original loan, pay our closing costs on that refinance, we'd recover about $33,500, which in this case, if we take the total investment minus the capital that we've recovered, we would leave $33,000 of our initial investment in this deal. So we did basically at this point, we'd have a property that's completely rehabbed, that's pulling in great rents for $33K. We would then have a new interest rate of 6.75. Our new mortgage payment is $730, and our cash flow in this case would be $645. So in this world, a cash on cash return of 32% would be the same as putting this money in the stock market and attempting to get a 32% loan or a 32% return on a stock. So I hope this was helpful as far as just how I walk through deals, how I analyze deals. If you have any questions on this, let me know. Feel free to reach out. But good luck finding deals and happy investing.